Anna, the top woman trader in the world, and I assist and experienced traders in generating profits. In this video, we'll discuss how to understand the stock market. See you after the intro. Good morning, traders! Before we dive into this fascinating journey into the world of the stock market, I have something important to tell you. If you want to see how to put all this great series we're about to discuss into practice, don't forget to check out my courses. There you can see how I trade on stock indices and commodities. It's like sitting next to me as I try to tame these financial bulls and bears, but without the risk of me stealing your coffee. Today, we embark on a fascinating journey into the world of stock market. I know many of you might thinking, oh no, it's going to be boring and complicated, but I make you a promise. We'll make this topic not only understandable, but even exciting. So get comfortable, prepare a nice cup of coffee or tea, and let's start this adventure into the beating heart of global finance. So, let's start with the basics. What exactly is a stock market? Imagine a huge virtual market as big as a whole world, but instead of stalls selling fruits, vegetables or clothes, here you buy and sell little pieces of companies. These little pieces are called stocks. It's as if big companies in the world was a giant cake and each stock was a slice of that cake. Fascinating, isn't it? Let's make a practical example to make the concept clearer. Think of a global company that everyone knows, like Coca-Cola. When you hear about Coca-Cola stocks, this is exactly what it means. Small parts of ownership of the company that produces your favorite drink. If you buy a Coca-Cola stock, it's as if you became the owner of a microscopic part of the company. You could tell your friend, hey, I'm the one of the owners of Coca-Cola. Sounds pretty cool, doesn't it? But how does all this work in practice? Let's imagine that a super innovative new tech company, let's call it Future Gadget Inc., decided to go public. What does this mean? In simple terms, it means that the company decides to sell parts of itself to the public to raise money and finance its growth. It's as if Future Gadget Inc. say, hey, we have practical ideas, but we need money to make them happen. Who wants to be part of this adventure? Future Gadget Inc. might decide to issue, let's say, $10 million share at $20 each. This means they are valuing their company at $200 million, 10 million shares, $20 per share. If you decide to buy 100 of these shares, you spend $2,000 and become the owner of 0.1000 of Future Gadget Inc. Seems like a small percentage, right? But think that you're becoming a co-owner of a company valued at $200 million. Not bad for a start, huh? Now you might be wondering, where do all these stock exchanges take place? Well, in stock exchanges, the most famous exchanges in the world are the New York Stock Exchange and Nasdaq in the United States. There are the important exchanges in almost every country. The London Stock Exchange in the UK, the Tokyo Stock Exchange in Japan, the Frankfurt Stock Exchange in Germany, and the list goes on. Think that even Italy has its exchange, Borsa Italiana, based in Milan. Once upon a time, exchanges were physical places where traders met and shouted buy and sell orders. Maybe you've seen scenes like this in movies with people in suits shouting that, waving arms like crazy. It was quite a spectacle. Today, however, the vast majority of transactions happen online through ultra-fast computerized systems. This has made trading much more accessible to everyone. You can buy and sell stocks from your smartphone while you're in the line at the supermarket or lying on the couch watching your favorite TV series. The price of stock is determined by a fundamental principle of economics, the law of supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. Simple, right? But things can get interesting when there is important news about a company. Let's make another example to better understand this concept. Let's go back to our imaginary Future Gadget Inc. Imagine that the company announces they've invented a smartphone that recharges with solar energy. It's evolution in the world of technology. Suddenly, everyone will want to own a piece of this innovative company. The demand for Future Gadget Inc. stocks will explode. What will happen to the stock price? That's right, it will skyrocket. Those stocks you had bought at $20 each could rise to $40, $60 or even $100 in a few days or weeks. If you had bought 100 shares for $2,000, your investment could now be $10,000 worth. They just quantified your money. You're already feeling like little Warren Buffetts, aren't you? But beware, Because the stock market isn't all sunshine and roses. The opposite can happen too, and sometimes dramatically. Imagine the Future Gadget Inc. announcing their revolutionary solar smartphone has a critical defect. It overheats and catches fire if exposed to too much sun. A disaster. Suddenly, no one wants the smartphone anymore, and consequently, no one wants the company's stock anymore. In this scenario, many investors will want to sell their stocks as quickly as possible. Supply will far exceed demand, and the price will crash. Those stocks that were worth $100 could plummet to $10 or even less. Your $10,000 investment could shrink to $1,000 or less in very little time. It's as if your money melted in the sun, just like those unfortunate smartphones. This extreme example brings us to a golden rule of the stock market. Never invest your money you can afford to lose. The stock market can offer great opportunities for gain, but it also involves significant risks. It's a bit like riding a roller coaster. There are accelerating highs and frightening lows. The important thing is to be prepared and not panic. Now that we've seen how the basic mechanism works, let's talk about the reasons why people invest in the stock market. There are several reasons and we'll examine them one by one. Get ready because some of these might surprise you. The first and most obvious reason is capital growth. In the long term, the stock market has historically offered higher returns compared to many other forms of investment. Let's take a concrete example. If you had invested $1,000 in Amazon stocks in 2000, today that investment would be worth more than $50,000. That's a 5,000% increase in value. Think about it. You could have turned the cost of a mid-range computer into a sum sufficient to buy a nice luxury car or make a down payment on a house. Not bad, huh? Of course, Amazon is an exceptional case, but it's not the only one. Many companies have seen the value of their stocks multiply over the years. Apple, Microsoft, Google, and Netflix. These are all examples of the companies that have generated extraordinary returns for their shareholders in the long term. Imagine you had bought stocks in these companies when they were still smart startups. You could be a millionaire today. But beware, for every Amazon or Apple, there are dozens of companies that have seen the value of their stock decrease or even go to zero. That's why it's crucial to diversify your investments, but we'll talk about that later. For now, keep in mind that investing in stocks is a bit like betting on the future. Some bets pay off big, others, well, let's say they make you wish you had kept the money under your mattress. The second reason to invest in stocks is dividends. Some companies, especially more mature and stable ones, regularly distribute part of their profits to shareholders in the form of dividends. It's like receiving rent from owning part of the company. Fantastic, isn't it? It's as if the companies was telling you, "Thank you for your believing in us. Here part of our earnings." Let's make a concrete example. Imagine owning 100 shares of Procter & Gamble, one of the most stable companies in the world, which produces consumer goods like Gillette, Pampers, Oral-B, P&G, currently pays dividend of about $3.65 per share per year. With your 100 shares, you would receive $365 a year just for being the owner of a small part of the company. It's as if P&G was giving you $365 worth of products every year. You could pay for your Netflix and Amazon Prime subscriptions with P&G dividends, and you still have money left over for a few pizzas. Dividends may seem small, but over time they accumulate and can represent a significant part of the total return on an investment. Moreover, many companies increase their dividends over time, which means your rent grows year after year. It's like having a part-time job that requires zero efforts on your part. The third reason to invest in stocks is protection against inflation. Inflation is the general increase in prices over time, which erodes the purchasing power of money. If you keep your savings under the mattress or in a checking account with low interest rates, the real value of your money will decrease over time. Due to inflation, it's as if your money slowly melted. Stocks, on the other hand, offer natural protection against inflation. Why? Because companies have increased prices over their products or services in line with inflation, maintaining or increasing their profits in real terms. This is reflected in the value of their real stocks. Let's make a practical example. Think about how much a McDonald's hamburger cost 30 years ago compared to today. the price has increased significantly, right? But the value of McDonald's stocks has also increased over time. If you had invested in McDonald's stocks 30 years ago, you would not only have protected your capital from inflation, but you would have grown it well beyond the inflation rate. It's as if you had a superpower that allows you to beat inflation. Now that we're seeing the main reasons for investing in stocks, it's important to emphasize once again that the stock market involves risks. There have been periods in history when the market has suffered dramatic crashes. These moments are like financial storms that can shake even the most experienced investors. Let's take the 2008 financial crisis as an example. In less than 18 months, from October 2007 to March 2008, the S&P 500 index, which represents the 500 largest companies listed in the United States, lost more than 50% of its value. Some who had invested $10,000 at the beginning of this period would have been left with less than $5,000. It's as if half of your money had vanished into the thin air. Imagine the panic and desperation of many investors during that period. However, it's important to note that the market that recovered and renewed new highs in the following years. This underscores the importance of having a long-term investment horizon and not panicking during periods of volatility. It's like crossing a desert. There will be moments when you think you can't make it, but if you stay calm and keep going forward, you'll eventually reach the oasis. Let's now move on to some practical advice from those who want to start investing in stocks. The first fundamental concept to understand is fundamental analysis. Sounds complicated, right? But I promise you it's simpler than it seems. Fundamental analysis is like doing an X-ray of the company. You examine the balance sheets, financial reports, growth prospects, management quality, and many other factors to determine the real value of the company. The idea is that in the long term, the stock price will tend to reflect this real value. It's like being a financial detective, looking for clues about true value of a company. Let's make a concrete example. Imagine you are considering an investment in Netflix. A fundamental analysis will look at factors such as the number of subscribers and the subscriber growth rate, the company's revenues and profits, the company's debt, competition in the streaming sectors, plans for expansion into new markets, the quality and popularity of Netflix original content. All these factors together would give you an idea of Netflix's real value and help you decide whether the current stock price is overvalued, undervalued, or fair. It's like trying to guess a person's weight by looking at their diet, lifestyle, and genetics, instead of simply putting them on a scale. Technical analysis, on the other hand, focuses stock prices and volume patterns over time. Technical traders believe that these patterns tend to repeat and can be used to predict future price movements. It's like being a meteorologist of the stock market, trying to predict the financial weather by studying past weather patterns. An example of technical analysis could be the observation that every time Microsoft stock prices touches its 200-day moving average, a line that represents the average price of the last 200 trading sessions, it tends to bounce upwards. A technical trader might use this information to decide when to buy or sell Microsoft stocks. It's like finding a pattern in a game and using it to your advantage. Another fundamental concept for those investing in stocks is risk management. A common tool for risk management is the stop loss. A stop loss is an order that is executed automatically when the stock reaches a certain price, thus limiting potential losses. It's like having a financial guardian angel that protects you from big losses. For example, imagine you buy Tesla stock at $700 and set a stop loss at $630. If the stock price falls below $630, they will be sold automatically. This way, you limit your potential loss to 10% of your initial investment. It's like putting a safety cushion on your portfolio. Another crucial aspect of risk management is diversification. As the old saying goes, don't put all your eggs in one basket. By investing in a variety of different companies in different sectors and even in different countries, you can reduce the overall risk of your portfolio. It's like being a poker player who doesn't bet everything on a single hand but spreads his chips across multiple hands to increase the chances of winning. For example, instead of investing all your savings in stocks of a single tech company, you could spread your investment among tech, healthcare, financial, consumer goods companies, and so on. This way, if one sector or company has problems, your entire portfolio won't be dramatically affected. It's like having insurance against market whims. Personally, in my trading approach, I prefer to focus on broad indices like the S&P 500 rather than individual stocks. An index like the S&P 500 represents the 500 largest companies listed in the United States, so investing in this index is like buying a little piece of each of these 500 companies in a single operation. It's like going grocery shopping and buying a cart already prepared with all the ingredients for a week, instead of having to choose each product. This approach offers several advantages. Number 1. Automatic diversification. Instead of having to choose individual stocks, you are automatically diversified among 500 large companies. Number 2. Lower volatility. Broad indices tend to be less volatile than usual stocks. Number 3. Less need for research. You don't have to analyze hundreds of different companies in detail. In my memberships, I show how I apply this approach in practice. For example, I may show how I bought the Eurostock 50 index when it was 4,000 points and sold it at 4,100 points, making a 2.5% gain in just a few days. It's like being a software who knows how to ride market waves, whether they are high, low, or even flat. In conclusion, investing in the stock market can be a great way to grow your money in the long term. Whether you decide to buy stock of individual companies like Apple, Amazon, or Johnson & Johnson, or whatever you prefer to invest in index funds or ETFs that replicate the performance of entire market, the important thing is that you do it with awareness and after careful study. My advice for those who are starting is to start with small amounts. You can begin with $100 or $200 a month in an ETF that tracks the performance of the global market. Over time, you will see how these small regular investments can accumulate and grow, benefiting from the effect of compounding interest. It's like planting a seed and watching it grow into a majestic tree. At first, it seems insignificant, but with the time and the right care, it can bear surprising fruits. Always remember that investing in the stock market is a journey, not a destination. There will be ups and downs, moments of euphoria, and moments of panic. The key is to stay calm, have a solid strategy, and think long term. Don't get discouraged by short-term fluctuations and don't try to get rich overnight. The stock market rewards patience and discipline. Remember that every successful investor started from scratch. Warren Buffett, one of the most famous investors in the world, bought his first stock at 11 years old. Today, at over 90 years old, he is still active in the market. This shows that it's never too early or too late to start investing. So, dear friends, are you ready to embark on this exciting journey into the world of the stock market? Remember, every great journey begins with a small step. Your first investment could be the beginning of a financial adventure that will change your life. Don't be afraid to take that first step. And if you really want to understand how I handle these situations in daily practice, my courses are just what you need. I'll explain exactly how to recognize signals on the charts of stock indices and commodities, how to set up proper money management, and how to protect your capital. You'll get an in-depth look at how I apply these strategies in the real world with practical examples and real trades. Think about where you could be in a year if you start learning the right strategies today. I look forward to seeing you in my courses, where you learn all these techniques in detail and much more. It's time to move from theory to practice. Remember, the market is out there, full of opportunities. It's up to you to seize them with wisdom, a bit of courage, and why not, with a little help from me? See you on the other side, budding traders. And remember, if you feel lost in the maze of charts, or if the PE ratio seems more complicated than a router instruction manual, you know where to find me. I'm here to turn your helps into loves, and your moments of panic into profit opportunities.